Political actions, like Trump's clash with the Federal Reserve, can significantly impact mortgage rates. Understanding these dynamics is crucial for navigating the housing market effectively. Let's explore how these political maneuvers might shape your mortgage rates and the broader market landscape. Current 30-year fixed mortgage rates hover between 6.5% and 7%, discouraging sellers from listing homes due to their low fixed-rate mortgages. However, inventory has increased by 20.3% year over year. This sets the stage for understanding how these rates impact monthly housing costs and the broader housing market dynamics. High mortgage rates keep monthly housing costs elevated, creating a supply-demand mismatch that affects home prices. Commercial properties face similar challenges, with high loan rates impacting capitalization rates and property values. This scenario sets the stage for the ongoing tension between political actions and the Federal Reserve's influence on interest rates. Trump's growing influence on the Federal Reserve is significant. Plans to fire Lisa Cook highlight his push to cut rates. However, the Federal Reserve only controls the federal funds rate, not mortgage rates. This political maneuvering could impact economic stability, but mortgage rates depend on Treasury bond yields and lender risk premiums, not just Federal Reserve actions. The Federal Reserve controls the federal funds rate, not mortgage rates. Mortgage rates hinge on Treasury bond yields and mortgage-backed securities. Lenders add risk premiums, influenced by inflation and borrower defaults. Despite political pressure, these factors primarily drive mortgage rates, not direct Federal Reserve actions. Lenders are increasingly concerned about rising defaults and inflation. With foreclosure filings up 13%, the risk of borrower defaults is significant. Inflation and tariffs further complicate the landscape, prompting lenders to adjust risk premiums. These factors directly influence mortgage rates, impacting homebuyers and investors alike. 10-year Treasuries are trading around 4%, with spreads at 1.7%, making wholesale loans about 5.7%. Consumer rates range from 6.7% to 7.2%. These figures highlight the complexity of mortgage rates influenced by Treasury yields and risk spreads, not just political actions. Understanding these dynamics is crucial for navigating the housing market. Trump's influence over the Federal Reserve doesn't extend to bond investors or Treasury yields. Investors are concerned about inflation and political instability, leading to weak Treasury bond auctions. Despite Federal Reserve rate cuts, 10-year Treasury yields have risen, keeping mortgage rates high. This highlights the complex dynamics affecting the housing market beyond political maneuvers. The Federal Reserve cut the federal funds rate by 75 basis points last fall, yet 10-year Treasury yields have risen, leading to higher mortgage rates today compared to a year ago. This highlights that Federal Reserve actions don't always lower mortgage rates, emphasizing the need to understand broader economic factors. Investors should focus on mortgage rate trends, not just Federal Reserve actions. Even if the Federal Reserve cuts rates, mortgage rates might not drop. Understanding broader economic factors is crucial. Political actions can indirectly affect mortgage rates, so monitoring Treasury yields and the bond market is essential for real estate investors to stay informed. Political actions indirectly affect mortgage rates through Treasury yields and the bond market. Real estate investors must monitor these indicators closely. While the Federal Reserve influences short-term rates, bond investors react to broader economic factors impacting long-term mortgage rates. Staying informed is crucial for navigating these complexities in the housing market. Homebuyers must stay vigilant about potential rate changes. High rates impact affordability and purchasing decisions. By staying informed, you can make better financial choices, ensuring you navigate the housing market effectively. Understanding these dynamics is crucial for making sound investment decisions in a volatile market. Real estate investors must focus on long-term trends and adapt to market volatility. Strategic planning is crucial, especially with fluctuating mortgage rates. Understanding economic policies helps in making informed investment decisions. This knowledge is vital for navigating the complexities of the housing market and seizing opportunities amidst changing conditions. Economic policies and political actions deeply influence mortgage rates. The Federal Reserve's decisions on interest rates, driven by political pressures, impact the housing market. However, Mortgage rates are also affected by Treasury bond yields and investor risk assessments. Staying informed about these interconnected factors is crucial for navigating the housing market effectively. Understanding the impact of political actions on mortgage rates is crucial for navigating the housing market. As we've seen, these rates are influenced by complex factors beyond just policy changes. Stay informed to make better decisions. Thank you for joining this discussion. I am grateful for you reaching the end of the video. I am here to be a resource for you and your sphere of influence, and would be honored to provide a roadmap of success with real estate, mortgage, and soon notary services.